Good morning, and this is the 22nd of July and another episode of Two Great Beards. Hi, Andy, how's it going? And we had a very quiet week last week, didn't we, really?
We sure did. As expected, we got very little data. There was some action in the markets in that there was some intervention in China to keep their currency from falling. But by and large, there was no auction supply. By and large, the bond market did very little. There was some action in equities, in particular, rotation beginning from what had been leaders, tech in particular, to the Dow Jones, things like financials and industrials. And that all made sense. Unemployment numbers still remain. Unemployment is not going down at all. The regular weekly data of jobless claims was strong. One big surprise was the CPI in the UK fell quite a bit from 11% expected to 8%. And that was a big deal. Still very high.
Yes, the bond market did very little. And I'm in 15 minds as to what the bond market does next. And I think the answer is that we're going to be stuck in this range let's step back. The Fed next week is going to hike. The probabilities are in the 90s of percent, and the Fed has never not hiked when the probabilities have been this high, and therefore it would be a real surprise if they didn't. So what we're
And
saying
there's no data between
yeah,
now and then.
and therefore what we're saying is that that hike is baked in. So what the market is going to argue after that is whether we get one immediately in September when the next meeting is, as the dot plots would suggest, or do we trade basically between no hike and one more hike as the terminal rate? That argument naturally is going to be determined by data, but it's not going to be determined until probably sometime in early August when we have other pieces of data which might corroborate or not, plus the QRA. So we will leave that for another time. But what I think is most likely to happen to the bond market in the next week or so is not a lot, as we basically just shuffle probabilities of another hike between, I don't know, 25% and 35%, and therefore a very narrow range, even with the yield curve not doing much. And therefore, that is actually quite supportive of equities insofar as volatility in the bond market coming down suppresses the VIX, that vol targeting funds then are encouraged to buy more. And therefore, you get these rotations like we did last week with the Dow making a very significant move, I think. Anybody who looks at the monthly charts of Dow will see that we've broken a 9-month range to the upside. And basically, the Dow is now catching up with what were the leaders, i.e., tech, and you're getting this rotation out of tech, which is now taking a breather and might well be in for a 2, 3, 4% consolidation, while the Dow takes up that leadership. And overall, if you look at a total stock market like the VTI ETF, that is not doing very much, and you're getting this rotation from tech into Dow stocks, which are financials, industrials, as I mentioned. So the Dow is the one which is catching up to the upside up, but I feel what is significant is that it's catching up to the upside rather than the others coming back towards it. And that tells me that the stocks are going to remain supported certainly for the short term.
Certainly next week. In terms of what to look for next week, as Nick said, the FOMC meets on Tuesday and Wednesday and will announce on Wednesday that they are hiking 25 basis points. And that is likely to be the only meaningful guidance because they have the dot plot, which indicates another hike after this one, another hike between now and the year end, and they're not going to take any optionality off the table. The same thing could be said
Absolutely.
about the ECB, and the hike is baked in. They also meet. One particular thing, which I think really was disclosed in a leak last week, was what the BOJ is doing. And there was actually a fair amount of volatility in the yen last week, going from, it had peaked over 145 yen to the dollar and fell down to around 138, I think, early in the week, and really recovered, both because China intervened in their currency and because there was a leak that the BOJ was not going to take any action this coming week. We'll see. But that it would be very unlikely that they, given the currency moves that's happened after that leak, where the currency moved back to 141, would be a big surprise and a big market reaction if the BOJ were to surprise based on what's built into this leak. So that's something to look for. That happens Thursday night in the United States. We won't see it until Friday morning. So that's another thing. And I guess lastly, for the week, we have data and auctions. Twos, fives, and sevens, about 120 billion of those come to market, and the core PCE, which is expectations are for low, and the CPI numbers were low, so you're probably going to get a low number, comes on Friday. And so when we add that up, as Nick was saying, not a lot of the all the central banks are baked in, and if they surprise, we'll mention that in an email. But not a lot of things that can move the market in a meaningful way next week, except for tech earnings are quite heavy and then extend into the following week. Tech earnings have been great, but they've also been expected, and so things have been priced in. I'm a little more nervous than Nick is about the equity market, though I agree it's a buy the dip. And I think the question is, how much will tech earnings, which expectations probably have some fluff still to come out, take the rest of the market down? And if you're talking about a 2 to 4% move down on tech, you're talking about a 1% move on the S&P, and probably nothing on Dow.
Yes.
So it's an interesting setup, but not very interesting as in terms of changing our investment philosophy, or for that matter, our macro outlook.
No, those stay very much the same. I think the bond market is going to have to start taking off the table the cuts that it has priced in for late this year, early next year, because that is going to take time to assess, and we are running out of that time. We're coming very much closer to the period where the market has priced in the beginning of cuts, and that could easily get postponed. So we will see. But as far as what there is to do at the moment, I think very little, but sit and watch and listen to what the central banks say next week. I agree with Andy that it would be a huge surprise now if the BOJ did anything, and I don't think that would be the way that Wader would like to start his relationship with market makers, by fooling them. I don't see the point of that. It would be counterproductive. So I think all three central bank decisions are baked in. The market is fairly priced for them, and therefore a low volatility week is the most likely answer.
And I think the high level point is, even if there is volatility, because as Nick said, there are still significant cuts, 150 basis points of cuts priced in starting in December for the next year. There's not a lot of upside in very short term rates, but there's also not a lot of downside, unless there's a creep of downside as those cuts get priced out and become pauses instead of cuts. And that keeps pressure on bonds, so limits their upside. But at the same time, the data is starting to be supportive of an eventual pause. So there's not a lot of downside either, which means low volatility. And so that's the high level point, which means that bonds are relatively stable, which means that equities are relatively stable. So while I'm not a buyer of bonds at the prices that we see because of that sort of negative creep that we're likely to get across the curve, buying stocks on a dip still makes sense. And I think the big reason to change is not going to be earnings. Earnings are going to be fine. It's going to be supply of bonds. And that next week, the episode a week from today, will go into the issuance that is going to be announced in the following week from the US Treasury. And that could have a meaningful impact on our macro thesis. May not, but we'll give you the guidelines on what to look for a week from now.
Yes, excellent. And as far as the portfolio is concerned, I don't think we need to make any changes apart from the bid that we have in at the moment for VWB, and then we wait.
Before we see our clients next week, we have the 440 puts that were short on the S&P expiring. They're quite a bit out of the money right now. They probably expire for nothing. If they do, is there anything we should be doing on Friday morning on a weak PCE after the expiration? Or I'm just
I think
here.
we should really wait and see Wednesday and Thursday, and then Friday morning we decide, or we could decide before then, but we will see and we will send out an email about
Exactly.
any things that we need to do. If there is a dip, we might easily sell some puts, maybe even some in the money puts, or buy some Dow. I think the Dow still has quite a bit of upside, about 4 or 5% within the next couple of months. But we will just wait for a better opportunity. I think we might get one next week or the week after that, after the QRA, as you mentioned, and we will decide then. I don't think there's any need to chase anything at the moment.
Okay, sounds good.
Great. Speak to you all next week. Not much change in our portfolio, but what I have done is I've inserted the 440 calls and the 440 puts that we are short of. I have put them in here at full notional value because they are so short term and this is what we are likely to be exercised on. I don't know how else to do it, and I've been asked by certain clients to include them in the sheet so they can see the allocations better. I've done it this way simply because I don't know how else to show them, and I will be changing the nominal value each week so that this helps you with understanding what our true allocation is. As I've written down here, they're included a full nominal value if in the money and at zero if out of the money. These 99% odds that these 440 puts expire worthless next week on the 28th, and 99% likelihood that these we exercise, and therefore that we will have a higher allocation in equities. So this gives you probably a better idea of what's truly going on in the portfolio. As to the broker statements, I have broken down, just like last week, the broker statement into two parts. One is a statement and the other one is an activity. And I've done this so that you can see the exact positions, but you also can see the activity that we had during that week. And that will be shown in this statement here. So if we click on it, you will basically see here in trades what was done. And really all that happened is that we managed to buy a one share in VWB at 62.10, and to finance it, basically what I did is I sold one share of USFR, basically just to get to the cash position of zero. You have that there, and you can basically download either or both of those statements as required by you. Now, the orders for next week, it's still very much the same. As mentioned, we got one share done at 62.10, so we picked the absolute low of the week. It's a good level. I always pick good levels to buy stuff at that I'm not really bothered if I get it or not. And it's still there, 62.10 for another 299 shares of VWOB. And naturally, if I get them, I will reduce the allocation of USFR so that I have as little money in the sweep as possible. And as we indicated earlier, we will be sending you an email either Wednesday or any time until Friday. If we decide to do anything, odds are that we can probably leave it until the next video next Friday on the 29th. But if we decide to do anything as a result of the central bank meetings and the core PCE, which is out on Friday, we will send you out an email so we have some optionality as well as the Federal Reserve. Thank you very much indeed, and speak to you next week.